I don't feel safe with my money in the bank. And so gold and silver represent, I think, something outside the system that carries no counterparty risk. And that's really what it's all about. It's not about becoming wealthy, it's about keeping your wealth and removing the counterparty risk and the systemic nature of the problem. So,
In a world where traditional financial institutions seem less reliable by the day, the question of where to safeguard one's hard-earned wealth becomes paramount. Join us as Andy Schectman delves into the heart of the matter. In his thought-provoking video, "I Don't Feel Safe with My Money in the Bank," Schectman explores why gold and silver represent more than just shiny commodities. As he unravels the systemic nature of our financial woes, he highlights the looming inevitability of a crisis. Are we prepared for the panic that could reshape our financial landscape forever? So, watch the video till the end.
it's not normal, but it's becoming normal. And, they spoke with my operations manager who said to the bank, yeah, this is all legit. You can release the funds. And they said, well, we need to have it go through compliance. And the response back was, well, no, you don't. Why do you have to let it go through compliance? This is the client's wishes. Yep. Well, we have to make sure that it goes through compliance. But we have seen, we go back to the order that we did last year for $50 million. One of the two orders that we did of that size, it took the lady almost 5 days to get the money wired. And that's why she wanted us to tell the world about it, that, hey, it's one thing, it's very easy to write the bank a check for $50 million and have them take it gladly. It's another thing to get it out. And what we view as our money, remember, we're unsecured general creditors to the bank. What we view as our money and our ability to get it is becoming much more difficult as these banks struggle with the mass exodus of deposits leaving in search of yield and of safety. So yeah, I think it is becoming normal and will become much more normal as well. I think that they've actually created some departments or positions at these banks called client retention management, because they are losing clients, they are losing deposits. It's a mass exodus, and this is not going to change. But people need to remember that when these depositors leave, especially if we see large deposits leaving or many of them leaving, this is what got Silicon Valley Bank into trouble. Now, that was a bank run, but the premise is the same, that these banks are undercapitalized and over-leveraged, and they're leveraged with what they thought was good assets, that being mortgage-backed securities and treasuries and muni bonds and all of these things that have lost 50 or 60% of their value. And if they aren't capitalized enough with money in-house in order to meet those deposits, they're forced to sell these assets at a loss, which really, really hurts them. So they're doing all they can to mitigate not only the speed in which the money gets out, but to take the bold step of pretending that they're our parents or our guardians and looking out for our best interests. And my question is, at what point did any of these banks ever become that entity that we have asked for? They're looking over our shoulder to make sure, look, if the client comes in and says, I'm a big boy, I'm a big girl, this is what I want to do, I have verified the wire instructions, this is where I want the money to go, call the company says the address is right, and it still needs to go to compliance, there's something really wrong with this. And it isn't your money, it's their money, and they're making the determination when and how easily, and if at all, that money gets released. That to me is rather concerning, and probably the beginning of a trend as more of this happens. We are going to begin using credit cards, but why pay 4%? We don't even mark things up 4%. And when you're talking about an ounce of silver at 4%, you're adding $1 or more to the price of the coin. So we acquiesced, and that'll be coming soon. But yes, I would much rather use a wire or an ACH. It's easier, it's quicker, and it's more straightforward and a better deal for the client. Here again, making the assumption that the money held in these accounts is easily transmitted, as it always was and always has been and always should be. I think it's really symptomatic of a bigger problem. And that bigger problem is that the banks are in a panic about more and more deposits leaving. And when when was it the decision of these banks to tell us what we could and what we couldn't do, or when we can and when we should or shouldn't move? They never say that about moving into to an S&P index fund or into a mutual fund or whatever it may be, and who gave them that authority? To me, it's very concerning. And those banks, if they're going to that length to make it that difficult to move your money, you ought to think about moving all of it immediately, especially with what we saw from Moody's just yesterday, where 10 banks were downgraded and 6 more, including 2 banks that I have money in, US Bank and Truist Bank. US Bank is everywhere in Minneapolis, where I'm from. And when I moved down here to Delray Beach, the first place I went was to Truist Bank. And what do you know? They're both on the docket, along with 4 others, to possibly be downgraded. You're going to see more and more and more of this. And heaven forbid we see a bail-in, which should have happened a long time ago. These banks should not have been bailed out. That's part of the Dodd-Frank Act. We see a bank get bailed in and watch the craziness when people run to pull their money out, and watch what happens then. So, yeah, I think this is something we're going to see a lot more of. The difference is very stark. And that difference to me is that it's one thing for us to sit here and say, stock market's overvalued and over leveraged and risky. The real estate market, the bond market, it's one thing to espouse economic theory and talk about how it could affect your investments. It's another thing altogether to say, hey, by the way, the money in the bank, well, it's not safe. And if they fail, the fact that these banks were bailed in or gobbled up by JP Morgan or Bank of California, which, by the way, JP Morgan was on the back end of that. I have a very good friend who's one of the top analysts at JP Morgan. He said he spent all week on that PacWest Bank of California deal himself in New York City. So the point of it is that these banks that have fallen already have been gobbled up or consolidated by JP, or were bailed out by the FDIC, supposedly not at the cost or at the expense of the taxpayer, which is a bunch of malarkey. The bottom line is that they're supposed to be bailed in. That's what the Dodd-Frank law said. And when you see that happen, you will see, I believe, a massive amount of anxiety, unlike anything anyone's ever seen. And that's what we're seeing now. People are saying, look, I don't feel safe with my money in the bank. And so gold and silver represent, I think, something outside the system that carries no counterparty risk. And that's really what it's all about. It's not about becoming wealthy. It's about keeping your wealth and removing the counterparty risk and the systemic nature of the problem. So it's a different mindset primarily altogether. And I think you see an event like any of these regional banks failing, and Janet says, no more bailout, no more consolidation, we're going to bail in. And people will understand what that means. It is law. The fact that it hasn't happened yet is only delaying the inevitable, and that inevitable will be a panic where that M2 line will fall off a cliff. And I just think that we're not there yet, but that is the difference, is that people are focusing not on their investments as much as they are their savings, and the chance of losing that is pushing them here. We know that that's not true. And look, it's also worth mentioning that this isn't just related to the regional banks, the ones that carry all the 70% of the commercial real estate loans, of which $1 billion plus have to reset over the next 15 months. This is also about the commercial banks, where the biggest money in the United States is rapidly pulling their money out of the commercial banks as well, and going directly to treasurydirect.gov would be my guess, or into precious metals, or into things outside the banking system. Because look, if you go directly to the Treasury and buy short-term duration treasuries, 6-month treasuries, you're betting on the US government. And if the US government fails, well, the banks are in big trouble, as is right there. So to see the amount of money actually dwarf money coming out of the commercial banks are dwarfing what we're seeing coming out of the regional banks. And those people, I would argue, are a little bit more well-informed. So this is not just an issue of money leaving the regional banks, it's also the commercial banks. So there is strain across the entire system. And as rates keep rising, more strain and more problems. So again, I don't think this is an isolated deal. I don't think that this is something that we'll look at the end of the year and say, geez, that was a scary deal. Good thing we got by it. I think it's just the very beginning, and I expect to see much more. So look, if you're concerned about your money in the banks or have too much in one bank, be proactive and mitigate your exposure. Spread it out. I've heard you say this before, over several banks. Go directly to the treasurydirect.gov and buy short-term treasuries, buy precious metals, do whatever it is you want to do, and do it before it becomes very difficult to do. It's already getting tough.
In a shifting financial landscape, it's crucial to consider alternative ways of securing your wealth. Andy Schectman's insights remind us that gold and silver can provide a haven beyond the confines of traditional banking. As we confront the inevitable challenges of our financial system, remember that safeguarding your wealth is not just about becoming rich, but about preserving what you've worked hard for. Thank you for joining us in this exploration of a different mindset, one focused on security and resilience. Please keep watching our videos, and don't forget to subscribe if you enjoyed them.